What's up guys, welcome back to the Daily Stock Picks. And in this video, we'll be going over 3 Robinhood stocks that you should consider buying right now, according to this article by the Monthly Fool. So what I'll be doing for you guys is I'll be reading over this article with my beautiful voice and commenting. And we'll be conducting my own quantitative analyses to see whether these 3 companies either belong in our dividend portfolio or our value portfolio by using this checklist. More on that later. So if you guys feel like being awesome and amazing, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. I hope that this video really does give you a lot of value because I'm reading the article for you guys and starting off my own analysis so that it can help you in your own research purposes before investing in these 3 companies. So without further ado, let's get this video started. So 3 Robinhood stocks that are no-brainer buys. Though Robinhood investors are known for chasing penny stocks, these widely held companies have the potential to make investors rich. By Sean Williams. So Wall Street and investors likely won't soon forget 2020. That's because we witnessed a decade's worth of volatility crammed into a 6-month span, which is pretty right from his perspective. And with what's happening in the economy lately, despite Fed pumping money and cash into the economy in order to support the stock market, the unemployment rate is at its all-time highs. So uncertainty surrounding the CVPD 2019 pandemic initially sent the benchmark S&P 500 index into a decline of 34% in less than 5 weeks. We then witnessed the most ferocious rally from a bear market bottom of all time. This past week, both the S&P 500 and the Nasdaq Composite hit fresh new record highs. Okay, while unveiling at times, this volatility plays right into the hands of long-term investors. That's because it allows them to buy great stocks at a perceived discount. However, heightened volatility can have unwelcome consequences too. More specifically, periods of wild vacillations in equities tend to bring short-term traders and penny stock investors out for the woodwork. If you don't believe me, just take a gander at the recent rise of online investing platform Robinhood, best known for offering commission-free trades and free shares of stocks or opening up an account. Robinhood has been particularly adept at courting millennial and or novice investors. I really think Robinhood is like a wonderful platform because it gives the flexibility for the new generation to invest in the stocks rather than going with the boring old companies that take a huge commission for every transaction that you make on their platform. So while I'm all for encouraging younger investors to put their money to work in the stock market, Robinhood hasn't provided these folks with the tools they need to succeed as investors, with many choosing to chase whatever penny stock is the flavor of the week. So basically, penny stocks are generally the stocks which are of low market cap and have a lot of volatility. So one day you can come across penny stocks that have raised nearly 100% or 200% because of the recent news. And since they have a small market cap, if an investor invests sufficient amount of money, they can pump the stock up. That's what penny stocks are. Generally, stocks which are less than $10 come under this category. But among Robinhood millions of members, some have stumbled upon some truly great companies. Here are 3 widely held stocks on Robinhood that should be considered by investors as no-brainer buys. So the first company in this list is Amazon, ticker symbol AMZN. Even though it keeps setting new all-time highs this year, it's not too late to buy into Amazon, ticker symbol AMZN. Growth story. As of mid-August, Amazon was the 12th most held stock on Robinhood platform. As you may well know, Amazon has been the prime beneficiary of the CVPD. With consumers staying home, online shopping has become an increasingly popular method of purchasing goods. Since Amazon controls an estimated 44% of all the online sales in the United States, according to estimates from Bank of America, the shift online sets Amazon up for success during the pandemic. But the news flash here is that Amazon was already set up for robust growth well before the pandemic. It's signed up more than 150 million Prime members worldwide, with the fees from these memberships enabling Amazon to undercut its competitors' prices. Further, the retail membership model keeps these consumers loyal to Amazon's ecosystem of products and services. Amazon has also seen robust growth from its infrastructure cloud segment, Amazon Web Services. In the CVPD impacted second quarter, Amazon Web Services still delivered 29% year-on-year growth, with the segment now on track for over $43 billion in extrapolated annual sales. Since cloud margins are substantially higher than retail and ad revenue, Amazon Web Services is Amazon's longer-term key to explosive operating cash flow growth. It's my contention that if Amazon simply continues to trade within its historical operating cash flow multiple of 23 to 37, it'll be at least $5,000 stock by 2023. That makes it a no-brainer buy. So I can see what the the writer is currently saying. So he's looking at it in terms of like a really short-term perspective, but let's have a look at a long-term perspective and see what the price valuations that Mr. Market might keep on Amazon stock if it does continue to provide these substantial growth rates, right? So what I like to do is in my tracker, type in Amazon. We can see that the price to earnings multiple is 130 when compared to the broader S&P 500 index, which is 30.16. And then in order for a company to meet my dividend portfolio, it needs to basically satisfy 4 rules. And the 4 rules are based on these 3 books that I read and the interpretation that I made from these books. So the first book is Dividends Still Don't Lie by Kelly Wright. The second book is Get Rich with Dividends by Mark. And the third book is The Ultimate Dividend Playbook by Josh Peters from Morningstar. And the 4 rules are as follows. Rule number 1 is that the current free cash flows must be positive. What do I mean by this? Free cash flows are basically the amount of money that the company literally gets after paying out all its capital expenditures, right? And we want to be making sure that you're investing in companies that have a positive free cash flow so that you can sleep well at night knowing that you invested your money in the right company. And rule number 2 is that whenever a company decides to pay out a dividend, we need to make sure that it is less than 75% of the free cash flows, because we want at least 25% going back into the company so that the management can decide what they want to do in order to increase its top lines and bottom lines. And as well, you never know when something might just go down south and the management might need money, right? And rule number 3 is that it needs to have a consistent dividend growth history of at least 5 years. So there are beautiful companies, wonderful companies that tend to increase its dividends just by owning, being a shareholder. So just as a general rule of thumb, I like to look for companies that are 5 years or more than 5 years. But if you're more on the conservative side, I'll ask you to stick with 10 years or more than 10. We'll analyze this as soon as we get to that part of the video. And the 4th rule is the buy criteria. So we only want to be buying the stock when the current dividend yield is greater than or equal to the 5-year dividend average. So we want to be buying the stock at the right time when it's on a markdown, right? And coming to Amazon, I like to use Y charts because it does a really good job of representing the data in picture skew format or in visually rather than looking at boring numbers. So looking at Amazon stock, we can see that the revenues and the free cash flows have been increasing substantially. But since it does not pay out any dividend, this cannot belong in our dividend portfolio at all because it's primarily a growth stock. Now let's see if Amazon meets our value portfolio. So in order for a company to meet my value portfolio, it needs to satisfy 5 rules, right? And these 5 rules are based on 3 books that I've read and the deductions that I've made from these books. The first book is The New Buffettology by Mary Buffett and David Clark. Mary Buffett is the daughter-in-law, or used to be the daughter-in-law, of the world-famous Warren Buffett. The second book is Rule Number 1 by Phil Town, a really good book. And the third book is The Little Book That Still Beats the Stock Market by Joel Greenblatt, and where he goes over his magic formula, which is a really good read. I highly recommend that you guys check out these 3 books. So the value portfolio criteria are as follows. Rule number 1, the return on invested capital must be greater than or equal to 10%. So basically, return on invested capital is the amount of money that you get back for every dollar that you invest into the company. So let's say that if you invested $100 into the company, if the company has a return on invested capital of 10%, it means that you were able to get 10% out as pure profits, right? And this $100 that you've been investing into the company, it is considering both the money that you've put in and the money that has been raised by debt and other stuff as well. So rule number 2 is that it needs to have a consistent net cash flows. And rule number 3 is that it needs to have a strong balance sheet. What do I mean by strong balance sheet? So generally, companies take out debt in order to propel or speed up the growth process of a company. So in order for a long-term debt, that long-term debt on the balance sheet could be an instrument of mass destruction. So the management should be capable of using this debt properly, and it should be able to manage it conservatively as well. So a good rule of thumb is that this debt should be cleared off within 6 years or less than 6 years if it is a wonderful company. And rule number 4 and rule number 5 are my buy criteria. So if you only want to be buying this company when the current price is lesser than or equal to 80% of the fair price. More on that later when we'll be using the intrinsic value calculation calculator. And rule number 5, if the rule number 4 isn't met, we can look at rule number 5, where only when the current price to earnings ratio is less than 50% of the highest P and should be lesser than the S&P 500 index. Now, coming to this, since it didn't meet our dividend portfolio, we can definitely see the value propositions that Amazon brings into the table. So the return on invested capital currently is 15.20, which is pretty good and definitely meets our criteria. There has been peaks and valleys, up and downs here and there, and it did have a return on invested capital of negative minus 40% back in 2012, but currently the return on invested capital is 15.20, which I'm pretty happy and stoked about. And the revenues have been increasing. It's almost like a straight line, and the free cash flows is around $2 billion, $2.5 billion. Let's see how many times it doubled. So 2.5 double is 5. That's 1 double, 10 and 20. So 3 doubles, so nearly 30% year over year growth on an annualized basis in terms of its free cash flows, which is pretty good for a company of this size. And so return on invested capital, definitely met this. Consistent net cash flows, hell yeah. Now the current balance sheet, we can see that it has a $33.13 billion as its total long-term debt in its balance sheet, which was released in a quarterly statement. And it has total current assets. So current assets are the liquid assets that can be converted to cash within 12 months or less. So these are the most liquid assets on the balance sheet. So it has a nearly mind-boggling $110 billion in its current assets. So it's definitely, it should be able to clear it off instantaneously and doesn't even need to take out any long-term debt because of its current cash flow positions that it has. So definitely a good balance sheet. Let's see the intrinsic value of the company. So the earnings per share for this Amazon is $26.01 per share. Now we need to be getting the price to earnings multiple to see how far the range is in terms of its price to earnings multiple. So 70.68, 1005.75. And now let's have a look at the Wall Street analysts' growth estimates that they're estimating that the company should be growing at. So 36% for the next 5 years, but I'll be considering this as 10. So now what we'll be doing here is we'll be taking this earnings per share 10 years from now, and we need to be multiplying it with the proper price to earnings ratio. So the most conservative way of looking at it is that you can either take the analyst estimates multiplied by 2, you'll get at a price to earnings ratio, or otherwise you can consider the price to earnings ratio of the 5-year average, which is 532, which is pretty bananas. You wouldn't be that optimistic about it. You want to be on the conservative side, even though if it doesn't meet the target, we can at least accept the minimum amount and we should be able to make a good return on our investment. So as a result, we'll be considering 72.06. Considering this valuation, 10 years from now, if Amazon does grow at this rate, it could be worth somewhere around $29,891. Now, bringing this back to present day so that we can get at least a 15% return on our investment, we want to be buying the stock when the fair price is $8,497, which is known as a sticker price, which was coined by Phil Town. And we never want to be paying the sticker price, right? We always want to be taking the company when it's at a margin of safety. So because we never know how the future is going to entail, we need to be making sure that we're protected against the downside. So considering a 50% on this, so we want to be buying the stock when it's around $4,248. And the current price of Amazon is $3,401. So it's definitely a buy for us. So let's have a look. AMZN. This is just basically a function in Google Sheets. So we can definitely use it for our value portfolio with the current price valuations, because Amazon, looking at it, it is more than a 50% discount at the moment, right? Now, let's go ahead on to the next company. I'm really stoked to see what happens with the other companies in this list. So the next company in this list is Square, ticker symbol SQ. Another highly popular Robinhood stock with the potential to make investors a boatload of money is fintech stock Square. As of mid-August, Square was the 64th most held stock on Robinhood platform with over 40,000 net users piling into the company since mid-March. As with Amazon, what people know Square for may not ultimately be the company's biggest long-term catalyst. In Square's case, most folks are familiar with its point-of-sale platforms for small and medium-sized merchants. Between 2012 and 2019, the gross payment volume traversing its network surged from $6.5 billion to $106.2 billion, although it's likely fall in 2020 due to the CVPD pandemic. What's noteworthy, however, is that large merchants are coming around to Square point-of-sale devices. Since the company sellers ecosystem is primarily driven by merchant fees and to a lesser degree by lending, larger businesses could have a very positive impact on Square's top and bottom lines. But the real growth driver for Square looks to be its peer-to-peer payment platform, Cash App. Getting a boost from the pandemic and consumers shunning off cash as a germ transmitter, Cash App has picked up more than 6 million new monthly active users, which is known as MAUs, in 2020. Between the end of 2017 and June of 2020, Cash App's MAUs have more than quadrupled from 7 million to over 30 million. Wow. So Cash App gives Square a variety of ways to generate revenue. For instance, the company sees revenue from merchants' fees when Cash App's users make purchases and also when users expedite bank to Cash App transfer and vice versa. Square is also seeing a lot of revenue from Bitcoin exchange and investments. Don't be surprised if Cash App becomes this company's primary source of gross profits in the very near future. So just a fun fact, guys. Square, I think one of the main investors is the Twitter CEO who founded Twitter as well. So now let's see if this company meets our dividend portfolio. So ticker symbol SQ. So since the company does not pay out any dividends, it definitely doesn't meet our dividend portfolio. Now let's see if it meets our value portfolio. Looking at the price to earnings multiple, we can see that it's 345.72, which is definitely on the expensive side when compared to the S&P 500 index. Now let's have a look at Square's fundamentals here. So the return on invested capital has been increasing substantially. Previously was negative, and from 2019 we can see that it's turned to the upward direction, and it's right now at 16.07, which is pretty good. And coming to the revenues, have been increasing as well. The free cash flows minus $55 million, and now it's moved all the way up to $403 million, though it is considered as like very small when compared to the mega cap companies out there. I would say that the company's return on invested capital definitely meets it, along with its free cash flows. Now let's see if it has a strong balance sheet. So looking at the balance sheet, we can see that the company has around $2.22 billion, which it can easily cover with its current assets of $6.187 billion if the company chooses to do so. Now looking at the price multiple, let's have a look. So the earnings per share is currently 0.62 cents. Now let's see the range at which the company has been trading in terms of its price to earnings multiple. So 48.83 to 51.50. Okay, and the growth rate projected by the analysts is SQ. All right, similar to Amazon, 35.59. So the earnings multiple would be somewhere around 71.18. Now, the intrinsic value 10 years from now would put the company somewhere at approximately $683.59, and the fair price at which we should be buying the stock is $194.32. And considering a 50% margin of safety is 97.16, but we can make an exception because of the strong fundamentals here, and we can consider buying the company at $155.46. Since the company is trading around this time, around this price of $156.02, it definitely does meet our buy criteria. So Square, let me just get that formula out. Rule number 4. So it's based on rule number 4 of the checklist. Okay, now let's have a look at the third and final company in this list. So the third company is Berkshire Hathaway. So Berkshire Hathaway has two shares, Class A shares and Class B shares. Class A shares are pretty expensive and Class B shares are pretty nominal, around the $100 range. Yeah. So investors also probably can't go wrong with the 72nd most held stock on Robinhood platform as of mid-August. Although the company's name might not ring a bell for some investors, one of the key reasons this stock is a no-brainer has to do with its CEO, a guy named Warren Buffett. Warren Buffett is the long-term investing success blueprint other money managers follow. Over the past 55 years ended December 31st, 2019, Berkshire Hathaway stock averaged an compounding annualized return of 20.3% compared to that of the 10% compound annual rate return of the S&P 500 index, inclusive of dividends received over the same time span. This 10.3% average annual gap equates to a better than 2.7 million percent outperformance of the S&P 500 index in 55 years. So a lot of people, just for getting a 20% or 30% return on a year, think that they're like these investing legends. But if you were to take in the long-term perspective, that would average down. Buffett has been able to average down his annualized returns at 20.3%, which is nearly double the amount of S&P 500 index. So aside from getting the famous Warren Buffett as your money manager, buying Berkshire Hathaway also ties your portfolio to the health of the US economy. As of a week ago, 92% of the Berkshire's portfolio was tied up in just 3 sectors: information technology, financials, and consumer staples. These sectors are highly cyclical and tend to do very well when the US economy is firing on all cylinders. The good news here is that periods of economic expansion last significantly longer than contractions and recessions, which means Buffett is simply playing the odds in his favor. Furthermore, Berkshire Hathaway is sitting on a mammoth pile of cash equivalents, and short-term investments of $147 billion. This cash acts as a bit of a downside buffer for Berkshire Hathaway stock and gives the Oracle of Omaha some firepower to go shopping if he sees a bargain. Don't forget, Berkshire Hathaway owns more than 5 dozen diverse subsidiaries. Given Buffett's and Berkshire history of success, the stock is a no-brainer buy following its 2020 pullback. All right, pretty interesting. So Berkshire Class A shares. Just for fun, Berkshire Class A shares are trading at $327,000, which is just bananas, right? And Berkshire Hathaway Class B shares, they're trading at somewhere around $218.55. So hundreds, this Class B shares are around $100 and Class A shares are around hundreds of thousands of dollars. So it doesn't encourage like trading this particular stock. So if you are going to buy into the stock, especially the Class A shares, you want to be looking at it in terms of a long-term perspective. Looking at this, the fundamentals would be the same because it's the same parent company. As it doesn't pay out any dividend, we can invest it as a dividend perspective, or we can definitely see it in terms of the value proposition it might bring. So BRK.B. Berkshire Hathaway. I'm not sure about Berkshire Hathaway's ticker symbol. BRK. For simplicity's sake, I'll be considering the Class B shares in this example. Yep, so the current price to earnings ratio for Berkshire Class B shares is 23.99, which is on a discount when compared to the S&P 500 index. Now let's see if it meets our value portfolio criteria. So Berkshire Class B, BRK.B. So 16.58, definitely return on invested capital is more than 10%. The cash flows, $11 billion, have nearly doubled. So its annualized compounding growth rate would be somewhere around 10%. So the cash flows are consistent. Strong balance sheet. So it has around $106 billion in long-term debt, which it can easily clear it off with its current assets of $183 billion. So definitely. Now let's see if it meets our intrinsic value calculations and see if it's on a fire sale like the other two companies. So the earnings per share is $9.109. As we've seen, and the price to earnings multiple variation is around this range. And the analysts Berkshire Class B are estimating that the company should be able to grow at a rate of 23.30. So considering the most conservative one, the price to earnings multiple should be $46.60. Sorry, 46.60, that's the multiple. And the fair price at which we should be buying the stock is $794. And considering a 50% discount, we can see that the company is definitely a buy right now because it's currently trading at $218.50, more than 50% of the discount at the moment. So Berkshire Class B shares, and it meets the fourth point in our checklist. So out of all the three companies, these three companies have met our value proposition because of its unique price markdown. And two of these companies, Amazon and Berkshire Hathaway, are at a more than a 50% discount, and Square is at a 20% discount from its fair price, which is definitely a buy. Now the closing remarks. So John Mackey, CEO of Whole Foods Market, an Amazon subsidiary, is a member of the Monthly Fools board of directors. Sean Williams owns shares of Amazon, Bank of America, and Square. The Monthly Fool owns shares of and recommends Amazon, Berkshire Class B shares, and Square, and recommends the following options. Long January 2021 $200 calls on Berkshire Class B shares. Short January 2021 $200 puts on Berkshire Class B shares. Short September 2020 70 puts on short on Square. Short January 2022 $1940 calls on Amazon. Long January 2022 1920 calls on Amazon, and short September 2020 200 calls on Berkshire Hathaway B shares. The Monthly Fool has a disclosure policy. So generally the writers and the publishers, they do mention if they own any other stock, because they want to be transparent on what they're recommending and what they currently own on their portfolio, which is a good practice. So if you guys have stayed around and are watching this part of the video, I really appreciate you guys for sticking along. Hope this has brought tremendous value for you guys. But full disclosure, this video is for your education and entertainment purposes only. There is no guarantee that you will earn any money using the techniques and ideas mentioned in this video. This is not financial advice. Please consult your financial or tax professional prior to making an investment in these companies. So thanks for watching, and catch you in the next video. Peace.